All right. Let's see how many people we got so far, huh? All right, got 5 of you so far. We'll give it just a minute or two, let some more people join. Thank you, Peter. I'm glad the video is coming through okay. Hopefully, audio is good too. Sorry for the late start, everybody. Had a bit of a rough night last night, so I just getting a slow start this morning. So get a sip of coffee in, and by then probably have enough people. We can get going. Excellent. All right. Well, I'm seeing closed captioning's working. Excellent. That's as I wanted it to. Perfect. All right. Well, welcome to week 4 of the Rational Investor School for Trader Development. This week we've been going over technical analysis. Fresh trade, you say you'd like to vent a little bit before we start? Or are you offering to me? I'm okay. I just needed to get a cup of coffee in me and get going. Hopefully this won't be quite the epic session we had last week. I really do like to keep this to around 2 hours, but we'll see. We'll see. It's more important to me that you all understand the material and that we make sure that that you're really learning what we're trying to teach here. So if we need more time, we'll take more time, but this should be a little bit shorter. So we'll see. Let me start. I did post last night, fairly late, a copy of, I should say, the updated slide deck. That's not what I want. This pinned messages, so you should be able to find that if it'll let you. Oh, that's allowed. Let you find that in pinned messages here. Maybe. Come on. It keeps sticking me in the lounge. Stop that. Okay. Message. What are you doing? Oh, that's really weird. All right, well, something behaving a little weird on this site. Well, let me see if I can find my post from last night, and I'll just repin it. That should put it at the top of things. Not a lot of new material in here. This is just updating links and things like that. But where are we at? Man. Where is last night? Just after here we are. Okay. So let me link for this, and we'll drop it in here. Okay. All right. And let me switch my view here, and I'll walk through that new deck, talk about the particulars in there, and then thanks, Steve. Appreciate it. And then we'll go through the Q&A, or sorry, we'll go through the quiz, and then we'll hit the Q&A sheet, kind of in that order. So, all right. Boom, if it'll let me. There we go. All right. So as I said, this last week we were reviewing technical analysis at a very high level. There's normal disclaimer here. All right, so the things that we are hitting in our topics here, we talked a little bit about what technical analysis is broadly. Talk about how it's a proxy for supply and demand. Talk about some of its drawbacks, limitations, different types of technical analysis. Talk about confirmation from a higher time frame. So a thing that I call anchor charting. Talk a bit about price analysis, how we define a trend, how we look at trending versus ranging markets. What do changing trends look like? Which is where market structure comes into play. And then we talk about how we can confirm what we see in the charts with volume. Then we'll move on to indicator analysis. We're going to talk broadly about indicators. We will dive more into indicators in coming weeks, where we'll spend time on an oscillator, on a raw volume momentum indicator, on a raw price momentum indicator, and we'll talk about how to fit all that into your trading plan. And then we're going to talk about convergence and divergence. Divergence is one of the most important concepts that I need you to get out of this week, between the market and transition patterns and divergence. Preferably you walk away from all of this with all of these topics in your head, but if you only capture a couple of them, those would be the most important ones. Then last but not least, we'll talk a bit about intermarket analysis, about correlation, fear and greed proxies, behavior of bonds and stocks, Dow theory. These are all different types of intermarket analyses that we can do, breadth studies, and some information we can get from derivatives that will help us. All right. So, what is technical analysis? So, at its core, technical analysis is the study of price action. Brian goes over, so I'm not going to rehash it too much. It goes over the difference in outlook between a fundamental analyst and a technical analyst at the mall, right? Talks about how a fundamental analyst is about assessing the value of an item and looking for price to be below that value, whereas a technical analyst is more concerned with how the market is treating that asset and identifying where the market is showing the current value to be, not the absolute value, but the current value. Ultimately, the market is the final arbiter when it comes to price of an asset. And what we mean by that is the fundamental analyst may have an idea of where the value of an asset should be. The technical analyst may see all the technical reasons in the world for price to move in a certain direction, and they can both be wrong, right? Ultimately, we need to remember that as technicians, be they fundamental or technical, all we can do is play odds, right? What we are doing is looking at statistical likelihood of price moving in the direction we want on our trades. We have no way of knowing how an individual trade is going to come out. And it's very important that you get that notion out of your head. It is the most pervasive and difficult thing to deal with as a new trader. But you have to accept that we have trades that are where we have more reason to believe that price is going to go in a given direction than other trades, and we can wait for that, but we weight the size of our bet. But we need to really get that ultimately we have no idea of how that individual trade is going to come out. What we're looking for is how groups of trades are going to behave, and we're looking for a statistical edge, which we only realize through multiple trades. Now, one of the big weaknesses of technical analysis that you need to be aware of as well is that technical analysis works best in absence of new fundamental drivers, right? You can see how things will be churning right along, and we get setups that come in on a technical basis, and we can do our analysis of how a market is looking. But when something fundamental hits the market, like we just saw this last week with the CPI report that showed that demonstrated inflation was fairly high, and the Fed talked about raising interest rates quite a bit more than they had talked previously. When we see fundamental events like this, those have a dramatic and profound impact on price. And so that can blow our technical analysis out of the water. Sometimes we can do our technical analysis and take into account those upcoming fundamental events, and it works fine. But we need to be aware. Just the height of my desk inadvertently. We need to be aware that the introduction of fundamental events will make our technical analysis less reliable. We have this concept of anchor charting, and I'll talk more about that in a few minutes. But I'm not sure what other analysts call this necessarily. Maybe they don't have a name for it. I like to call it anchor charting because I think of it as setting your anchor on the larger time frames and then using that to guide your lower time frame activity. But effectively, what we want to do is look on a higher time frame and see what the trend of the market is. And we want to then, on our chosen time frame where we're taking our trades, we want to take trades in the same direction as that higher time frame trend. Okay? And like I said, we'll talk about that in more depth in just a few minutes. Now, there are 3 schools of technical analytics that we are concerned with in level 1. There are some sub-schools that come into play later on when we get into level 3. But for now, there are 3 primary schools of technical analytics. There's price analysis. Okay. That's analyzing literally the price movement, right? There's indicator analysis, which is kind of your once removed models where you are looking at, and typically visual on these charts, but you are looking at a mathematical relationship to the movements of those charts. And then we have intermarket analysis, and that's where we're looking at markets that might be correlated, meaning they move together, or might be inversely correlated, they move apart from each other, to give us an idea of future behavior, right? Okay. Now, underlying all of this, and this is something that applies not just to price, but we use this with regards to indicator analysis. We use this in regards to some of our intermarket analyses as well. You need to understand what a trend is, and I'm gonna say these things again and again and again over the course of this program, right? A bullish trend where we're expecting price to go to continue up. A bullish trend is when we see higher highs, right, and higher lows. You can see these lows here. You look on the left of the chart that's on the page, you can see a bullish trend. Okay. On the right of that chart is a bearish trend. That's where you see lower lows and lower highs. Then we deal also with ranging markets. Now, that's where we see price moving between two values again and again, right? Now, there's some nuance here that's important to understand. Can you see how during a bullish trend, we have times when price moves down, right? Price doesn't move in a straight line in the markets. It moves up and down, but what we're looking for is a series of higher lows and higher highs for a bullish trend, lower lows and lower highs for a bearish trend. But within that trend, as we look at a smaller chunk of that, we can see there is a time when there is an uptrend during that downtrend. During a ranging market, that usually consists of uptrends and downtrends between these two channels, right? So describing the market state is often about time frame and what time range are you talking about, right? So if I see a bullish trend on a daily chart, when I am looking at a 30-minute chart or a 15-minute chart or somewhere shorter than a day, I may see that we are in a bearish trend on that time frame, right? Now, the whole idea of anchor charting is that means I would then wait until we got to a point where I have a trend on the lower time frame happening, which is aligned with my higher time frame trend. Okay, so if I'm on a bullish trend on the daily, and then I look down at my 30-minute chart, and that's what I want to trade on, I'm going to wait until we have a bearish pullback and look for a reversal back into a bullish trend in line with that daily trend. Okay. Now, we've got common price patterns of that reversal process, right? And I've provided links to breakouts that we have of these images. And if you go to the stock, you can click on them, but I will also bring them up in my browser, and we can look at those in a few minutes when I'm done with the presentation. Hang on a second. Let me throw those onto there. There we are. Okay. And actually, let me switch my screen view for just a second. I want to go to Trading View and show some of this stuff. Boom, 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 boom. There we go. Okay. So what I need this guy. Okay. So as I said, there are these links to larger views of these breakouts. Also, at the top of the Q&A document for this week, I provided links to those as well. Okay, so those are there. I saw somebody asking a question about that. So I have an example here. I think actually I might have shown this in the spreadsheet, so or in the presentation. So I'll show this here live so you can kind of see how it comes together. And we may just skip a couple slides as we go through. So this was last week when those CPI numbers came out. Okay, so that happened just before market, an hour before market opened for New York. Right here, this candle is where that happened. Okay, so we had the CPI report that came out. This is the S&P 500 futures market. Okay, and you can see how price immediately on that news starts going down, but then reverses back up. Now this is very, very common. And I put a note in here, do you think it's an accident price ran after these stops before moving down again? So institutions use the stops that we have to get orders filled and get their position set to move in the direction they want to go. So very often what we will see is price moved up here, and I believe this is an engineered move by the institutions to push price up to here above the levels from this candle, which is where people would have set their stops, so they can then move the market on down on that news. Okay, so the key part for me is the day opens, this is happening, I can't really participate yet, right? It's just a down market. I am waiting for something to establish. Now, I know the CPI numbers came out. I know that they're low. I know that that would typically mean a move down. I see that move established here, right, with these lower highs and lower lows. Okay. And then I need to just wait on the lower time frame. Okay. So on a lower time frame, I am looking at a 3-minute chart. Okay. And on a 3-minute chart, we see this come down here. This white line is just what I drew for my trend. There's a setup that you all are going to learn called the 3-step setup that came into play here, where we came down. Then this is not the initial reversal. The initial reversal was here, right? And so we just wait, get down here, and then we pulled back up. Okay. And then as we came up here, we established these 3 lower highs. Now, I want you to notice something that occurred in here, and I think I drew this on the 5-minute chart for you all. I traded this on the 3-minute, but I think I drew it on the 5-minute just so it's a little easier to see. You can see price making higher highs and the indicator making lower highs. Okay, that's what we look for when we look for a bearish divergence, a divergence where price is going to be heading down out of that divergence. Okay, that's what we're looking for. If we were looking for a bullish divergence, we'd be looking for lower lows in price and higher lows on the indicator. Think of this as the pressure from the other side of the move, right? But we had this divergence. That divergence confirms when we get an M printed on the indicator. So that's on this candle. That's where the divergence confirmed. After that divergence confirms, with this particular setup, what I look for is 3 successively lower highs. There's my first one just before that divergence confirmation, second one here, third one here. Then we look for price structure. So we look for market structure in price following that. And what we have here is a high, low, lower high, lower low. That's our M in price. Now, I don't get in here. I look to get in on so like this move down to here, I look to get in on a retest. So after prices move down here, and I actually waited for it to go below this level here because of this wick, or rather this tail. I wanted to go below that, so I waited for that here, and then I looked for price to come back up to the midpoint of this M to get filled. And that's where we took our short, and we ride it on down. Okay. Theo asks, Grimm, you just mentioned lower highs and lower lows. It didn't seem everything was always a lower high and a lower low. How do you determine whether it's ranging or truly trending, especially when it's going to be happening in the future and hasn't always happened in the past? So when I'm talking about a lower high and lower low, I don't mean the individual candles. What I'm looking for is peaks. So we're going to learn something when you get into the candlesticks, which I think is week 7, called a fractal. That's going to help you identify this. But what we're looking for are the pivot points, right? So can you see how price came up and pivoted here? And then you can even see that it pivoted here, but then it came up above that a little bit, created another pivot, but that was still below this one. That's what I mean by lower high. Okay. Can you see how price made a pivot here and then a pivot here So that's lower lows. Okay. It's those pivots that we care about when we're identifying lower highs and lower lows. And how we know it's not a range is that's where we're looking for what we're calling market structure. We're looking for these pivots that move us between lower highs and lower lows. And it's also important to understand that, again, like I was talking about earlier, we're going to see trends on a lower time frame, and those will be within ranges on a larger time frame, right? That's very common. So and we'll get into the reasons for this short in here. The main thing I wanted you to see was that we will often see a higher time frame move, and then we look for a lower time frame move to get in. So, I don't expect you guys to understand all of this yet, right? But we're gonna pick this apart. We're gonna learn all the elements that were in here. But the main things I wanted you to see is that on a higher time frame, I saw on the 30-minute, I saw this move down. And so then I knew I needed to wait for a setup that I could take a short trade on my lower time frame that I'm trading. Okay, that's the key thing. I always use Wix? That's a really good question, particularly in reference to market structure. You don't have to. This is one of those personal fit things, but however you do this, do it the same way consistently in all of your testing. I use Wicks and Tails to describe my M's and W's, but for a confirmation, I need a close, which is a candle body beyond the midpoint of this move. So I always use Wicks and Tails to describe my move. For a few reasons, not the least of which is we're going to get into candlestick pattern analysis in a couple weeks. I think I said week 7 was what we were looking at that. And candlestick pattern analysis requires that we use Wicks and Tails, so I don't want to switch back and forth mentally between the two. So, all right, let me get back over to the presentation here. But I just wanted to show you guys that that kind of setup live and how we think about the trade that we see on a higher time frame move in a certain direction, and then we want to wait patiently, and that patience is hard, right? Like this was when you're staring at the charts, this is a pretty long amount of time. It's not uncommon at all. So when did it fire here, right? It's not uncommon at all to see a trader who has on one screen his charts because he's kind of watching those, and on the other screen he's watching a show or he's playing a video game or something like that. It's pretty common because you don't want to be like overly stressing. But this was like 10 hours of waiting, right? It was most of the day. And it's not uncommon, even like as in my day trading practice, it is not uncommon for me not to have a trade in a day, right? You don't trade every day. In my swing trading, there's been times, it's like not super common, but it's not beyond the pale. There have been periods of 2-3 weeks where I've had no trades on my swing trading. That's just how it works. So you got to be patient. Okay. All right. What was I doing? Switching back over to boom here. All right. So that's excuse me. That's how I wanted to show you one more thing. Volume confirmation. So when we are, I don't know that I had that in my example here. I don't. Let's see if we had it. If we throw volume back on here. Okay. Well, we'll get into. There's not really volume confirmation on this particular trade that I can show you. Oh, that's unfortunate. But sometimes when we are looking at our market structure, what we will like to see is when we see, like in the case of an M, right? When this market structure confirms, see like a big rise in bearish volume, right? That'll give us a good confirmation of that market structure. It's not always there, obviously, but when it is, that gives us a higher degree of confidence in our analyses, right? Okay. Okay. Sorry, I just want to make sure I can see questions as they come through. All right. Skyfire says, in the dual screen example you just cited, isn't it dangerous to become distracted? Or is the purpose of that distraction to take away the anxiety so you don't do something foolish? The second part of that. The purpose of that distraction is to take away that anxiety. When you were just waiting on a chart, your anxiety level can increase quite a bit. And so it's all about reducing that anxiety. As long as you know what you're looking for, and so you may not do this at first, right? At first, you probably do want to be like glued to your screen as you're learning what you're looking for, right? But once you have established that, it's important to manage that anxiety. So as I say, it's not uncommon for traders to do that, right? But you also have to be, how do I put it? You have to have developed the belief, which comes with time, because you can think this all day long. It's when you believe it that it becomes really valuable, and this only comes through exposure to the markets. You have to believe that there will be another bus in 10 minutes if you miss this one, right? Because you might be distracted. You might miss that come in. And if you miss that, you're going to kick yourself a bit. But you need to recognize as a trader, remember, it's not the individual trade that matters. It is the sets of trades. And there is always, always, always another opportunity. Theo says, might VIX volatility also be an indicator? You were just using a volume indicator. Sure. Yeah, you can use VIX. I use VIX in my day trading setup. I've got a, I'll show you it a little later, but I've got the VIX setting up above my main chart. And I do keep an eye on that because if we see a big move in price and there's not a corresponding move in the volatility for the instrument, that can give me an indication that it's a false breakout, right? So, all right. Am I showing the right thing? I think so. Okay. Now, these markets in transition, right? These patterns that we look for do not guarantee that price is reversing or that will continue, but these give us a good idea of it. And most importantly, price can reverse without these patterns. Price can reverse with these patterns. What is important to us is when we see price reversing with these patterns, that gives us some information. That gives us some tools that we can use. Specifically, we can frame where we are going to put our stop. And we can look at where we're going to enter the trade, right? So let's go over the patterns, and I'll talk about kind of my my two methods of entering a trade. Okay, there's like the how do I put it? There's something standard, and there's my cheapskate version. Okay, so double bottoms. And all of these are, it's important to understand remember what a trend is. A bearish trend is lower highs and lower lows. A bullish trend is higher highs and higher lows. These are all market state transitions into one of those directions. Okay, so a double bottom is a transition into a state of higher highs and higher lows. Now we start with the higher lows. That's this low and this low. They might be near the same level. What you really want to see is you want to see this number 2 here a little bit higher than this number 1, right? And so that's your higher lows, and then we get higher highs up here, and that's what the breakout is. That is when we close above here, then we've got a higher high to go with that higher low. Okay, we refer to this as a W. And then what we refer to as an M is also called a double top in the industry. It's the same thing. We want a high, and then we want a lower high, followed by a lower low. And the lower low is our confirmation. So when we break below this first low. So that's an M and a W. Remember, we're going to see this not just in price, but we look for this in indicators as well. So we call it market structure. When it is in price, we typically call it price structure specifically. So that's double tops and double bottoms. That's our most common thing that we see. And we also see triangle breakouts. Oh, you can't see my cursor. Hang on a second. I've got to change my my view to see my cursor. Because I have to show my whole desktop then. So let me switch to this and expand this up a little bit. All right, so now you should be able to see my cursor. Come back here. There we go. Okay. So we've got our triangle breakouts. Now it's worth noting that triangle breakouts might have M's or W's in them, just like our heads and shoulders that we're going to talk about in a minute. So these can exist within each other as well, right? But with a triangle breakout, a symmetrical triangle breakout is where we have we're moving from a consolidation, so lower highs and higher lows. See how this is getting compressing, right? And then we see a breakout from that. And it can break out in either direction. Just because we're bullish here does not mean this is innately a bullish pattern. A triangle can break out, a symmetrical triangle can break out in either direction. Okay. Then we have an ascending triangle pattern. Ascending triangle pattern, we have kind of a defined flat top. So we have a specific level that we are testing against, and then finally breaking through. That might be 3 times. It might test 5, 6, 7 times. But eventually it will break through, and the key defining factor is as we are testing against this, we're, describing higher lows as we keep testing against the same high, and then we'll break out against it. And the descending triangle is just the opposite. We have a level down here that is acting as resistance, and we test against it, we test against it again, we test against it again, maybe a few more times, and eventually we break through there. And while we're doing that testing, we are seeing progressively lower highs. Okay. And then we've got a head and shoulders pattern, right? And so that's where we see the transition in the pattern so for regular head and shoulders, that's bearish. We are looking for coming from a bullish trend into where we've established this flat, and we basically paint a descending triangle on the right hand side of that. Okay, so that's testing there, and then we break through that, and that neckline is preferably flat, right? Again, we're trying to describe a single level, just like with the triangles against which we are testing. Now that's not going to be exact to the point, but we want that, because these levels of support and resistance, you'll learn about them more in level 2, but they're areas, not specific lines typically. And so I'm okay if there's a little variation on here in angle, but you want it kind of as flat as possible. And then inverted head and shoulders, just the opposite. We had a bearish move. We established kind of a neckline. So we had our lower highs and lower lows, and then we came up and retested that same level. And then we come up here, we make a higher low, and then we test it again and break through. And that's an inverted head and shoulders. What things to consider to spot a W pattern correctly, colleague? I think the biggest thing, let me go back here. I think the biggest thing people don't get correctly because they're not thinking about it being a transition into a bullish or bearish trend is they will look at something and be like, this looks like a W, but I'll look and we'll see the right hand low is lower than the left hand low. That is not a double bottom. And that's described that way sometimes in the industry too. But since we're looking for this to be a transition into a bullish state, that right hand low needs to be at least the same level, preferably a little higher than the first low, or in the case of a double top or an M, it needs to be a little lower than that first high, that second high. Okay, that's probably the biggest thing people do incorrectly when they're identifying M's and W's. Oh, here's the thing I was showing you earlier. And by the way, there's these images in the document link to the screenshot that I took of the trade, so you can look at that later. Yeah, this is just my anchor charting concept. If you have a paid TradingView account, you can set up your chart so that you have a split chart where you can have your like hourly or daily or whatever your higher time frame is on the left hand side or right hand side, and then on the other side you can have the time frame that you're trading in normally, and you can link those so that when you put the cursor on one, it shows you the cursor on both of them. It's kind of cool. This is just what I was talking about here. You want to swim with the tide. You want to have your chosen time frame. You want to look for trades in the same direction as your higher time frame that you were doing your analysis on. You need to be aware that price does not ever move in a straight line, that there will always be movement up and down as price is moving in a direction, and that institutions do need to hunt liquidity to move in volume. In order for the institutions to get short, they needed to push price up here so that they could eat these stops that are up here. So when people are short up here, they usually have stops set up here, buy stops. Well, the institutions are going to push up there. They're going to eat those buy stops, because remember, the other side of that buy order is a sell order. They're going to eat those buy stops by putting with their sell orders so they can drive their price down, right? It's a very, very common thing we see. Call it a stop hunt. All right, so that was price analysis. Let's get into indicator analysis. So, indicator analysis, and I have a little link to the Investopedia page on it. It's just a class of metrics whose value is derived from generic price activity. I would say that can also be derived from volume activity. We'll see that when we get into volume analysis. We use an indicator that is derived from volume rather than price. Technical indicators look to predict future price levels or simply the general price direction of a security by looking at past patterns. Okay. Examples of common technical indicators include relative strength index, money flow index, stochastics, and MACD. Okay. Now we can group indicators into a couple different types, and an indicator can be both of these types. Okay. We have oscillators. That's where where the indicator has an overbought and an oversold range. So RSI. The RSI will never be above 100. It will never be below 0. Okay, that's mathematically, that's how it's set. And then there's an overbought, by default above 70. Oversold by default is any below 30 value. Okay, that's an oscillator. It oscillates between the upper boundary and the lower boundary. Okay. You can think of this, we talk about it being a rubber band model, right? You can think about it as you get stretched into one, there's a lot of impetus and force to push it the other direction, okay? And then we have momentum indicators. And that's where we have the idea that as price moves in a direction, it is more likely to continue moving in that direction. Now, eventually it won't. Eventually it will stop, right? But that's where we look to lower highs and lower lows, or higher highs and higher lows, right? And that's where I say an indicator can be both. RSI is both. Now, we will teach you in the course, we prefer a raw price momentum indicator and a raw volume momentum indicator. These are not oscillators. These just are purely just showing trend, okay? And then we have a separate indicator that we'll teach you for looking at oscillation. So we'll get into that as we go through it. Hang on. All right. It's funny. I was just reading a note about how I could get distracted from my slide deck, and I got distracted from my slide deck reading the note. That's funny. And then, so with those indicators, we obviously look for convergence and divergence. And that's what I was just showing you. Particularly divergence is something we look for a lot. And that's when price is moving in one direction and the indicator is moving in the opposite trend. Okay, that's divergence. Convergence is the opposite. It's when price and the indicator are both moving in the same trend. All right. And I just gave a couple examples on here of this deck. This is when we're talking about oversold and overbought. This is what we mean, right? It's moved into the outside of the central band. When we talk about momentum, this is what we're talking about. We try to look for M's and W's. So this is a bullish trend where we're getting a W in here, right? And then I showed a couple examples of divergence. Again, these are all live links, so you can click on the bigger chart pattern. But this showed a bullish divergence where we had lower lows in price and higher lows on the indicator. And this red line is where that W gets confirmed. So I've drawn a line here. This is the candle. When this candle closed, we had confirmed divergence here. Now, does that mean we get in right there? No, we look for market structure in price after we have that divergence. Eddie says, how do you define overbought and oversold, considering RSI can stay there for a long time? We'll get into that when we get into looking at the MACD the Willy, which is our chosen overbought and oversold indicator. There's a thing that's called an embedded state, and that's where when we're in a trend particularly, we will see an oscillator remain in its overbought and oversold condition for prolonged periods of time. And we can look at how long that is, and as that progressively gets less and less, that indicates that that trend's internals are weakening a bit. But the short version of this, the TLDR, until we get to Willy Week, the TLDR is that we typically only want to use our oscillators when we are looking at ranging markets. When we are in a trending state, those oscillators are a lot less valuable because of that possibility of an embedded condition. Theo says, so W's, M's, triangles, etc. all apply to other indicators, not just price. That's correct. Yep. They do serve us as price structure, where it defines the risk on our trade, where we want to risk to the bottom of that price structure. But and I should talk about that in a minute. But we also use them within the indicator. So that's how we confirm divergence. Okay. Similarly, up here I've got a bearish divergence and don't worry about this. These are just the fib charts that I had on when I was doing the analysis. We'll learn about fibs in just a little bit. That has to do with location, right? And that reload zone that you've seen Brian talk about a lot. But what we see here is higher highs in price and lower highs on the indicator. And then that gets confirmed down here. Sorry, I didn't mark up the candle of confirmation, but it's right around this one, I think. When we confirm below, no, maybe it's a little later. Looks like it's about here. So yeah, so that is divergence. That's what we're looking for. And the key thing here is to remember that when we're looking for bullish divergence, we are looking at lows versus lows. When we're looking at bearish divergence, we are looking at highs versus highs. Okay, and they get confirmed by the market structure. But that's the mistake most people make, is they will be looking for a bullish divergence and they'll look at highs, and that is the wrong thing to look at. Okay, lows versus lows. Okay. All right, so intermarket analysis. Oh, I did promise you one thing. Let me do that really quick. When I look at price structure that occurs in the marketplace, there are a couple different ways of entering. Okay, so we have this M, and let me draw this M just so you can see it. It's not necessarily going to be clear for all of you. Let's go boom, 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 and like I was saying, by the time we got here on this one, it dropped a tail. I didn't love that, so I waited a little bit here until we had confirmed beyond that tail. Okay, so that's my M. There are two ways of entering. You can enter on the candle body open of whatever candle confirmed this price structure. This is the cheapskate method. Okay. In this case, it didn't get you very cheap, but it's the cheapskate method. You wait for a move back up to this level. Let me make this yellow and solid so we can see it a little better. Okay. That is one way we're doing. Now, sometimes that's going to be way up here, right? In this case, because this is a very small candle, there's not a lot of difference between these two levels, but just in practice, there's quite a bit typically. So that's the candle body open of whatever candle confirmed the structure. And this is going to apply here. It's going to apply later when we learn candlestick patterns. That's the cheapskate method. The other method is to look at the midpoint. Whatever level was the level that was needed to be passed in order to confirm it, we look for a retest of that level to get in. Okay, and that's what I did here. All right. These are kind of two different methods of entering off of that trade. Now, when we enter, we have to set our stop for a break of whatever that market structure is. So in this case, it's a break of this high, because this high is the highest high of that M. Okay, that's where we set our stop. That's where we enter. Okay, and market structure, that's what price structure is going to tell us. Market structure and price is going to tell us where we set our stop and where we enter the trade. Where we exit our trade can be defined a couple different ways. We're going to learn a way in the Fibonacci week, which is the thing that's used for all the setups I'm going to teach you here. With two of the three setups I'm going to teach you. You can also look to exit if we're on like in my planting flower setup, we just exit when the price doubles from wherever we entered at. And we can also just define our exit as like 2 times whatever our risk is, right? This is closer to 3 times with this bot setup. But these are the different ways that we can frame our trade. Brian, you're confusing people. Be nice. Yeah, so that's how we use price structure to, that's what we call framing our trade. We're defining where we're going to set our stop. We're defining where we're going to enter the trade based on that price structure. Okay. All right. So having shown you that, let's get an intermarket analysis. Now, oftentimes, individual assets can act as a proxy for their sector or industry or asset class. Okay. For example, we were talking in previous weeks, we were talking about the fear-greed cycle. We are talking about the relationship between two asset classes, equities and commodities. And we use a proxy for each of those. We use the Dow Jones as our proxy asset for equities, mostly because we have the longest data for that particular index. And because it's an index, so it aggregates a bunch of individual equities. And then we use gold as our proxy for the commodities market. You could use another commodity. I think there's a pretty big argument right now to use an index of gold and Bitcoin to represent the commodity market. But that's what we mean when we say proxy. It's a single asset whose behavior tends to mimic whatever that group is, right? For example, when we talk about a investor fear proxy, we talk about using the US dollar. And typically the proxy we use for US dollar is the DXY index. So if we come in here and we type DXY, right, that gives us a proxy for the US dollar. Now, is this the US dollar? No, not really. This is an ETF. It's a basket of assets, but this is what we use to represent the US dollar for our analysis purposes. All right. Now, we like to look at correlations and inverse correlations between assets. Some examples I have on here, and I did provide you some links to a couple of these things. We have often seen stocks and bonds inversely correlated. In other words, for bonds, we often use the TLT as our proxy, and for stocks, we might use the SPY or the Dow Jones, right? And when we see one go up, we typically see the other one go down. Now, those correlation relationships are not pegged; they are not fixed. So sometimes those are going to correlate, and sometimes they're going to inversely correlate. And what's interesting to us is the times when that changes, right? So when stocks and bonds, we typically see them inversely correlate. When we suddenly see them correlate, that means something, right? Usually it means there's something going on with the dollar, because that is used to enumerate both stocks and bonds, right? We also look at different terms for the same or similar assets. So bonds versus bonds. When we look at the yield curve, let me bring this up here. If I can, I'll open it over here. We have the yield curve. What the yield curve is a relationship between the 3-month, 2-year, 5-year, 7-year, 10-year, and 20-year bonds. Okay. And so it's looking at the bond yields for those different lengths of time. And what we are fearful of, well, fearful is probably too strong a word, but what the market is generally watching for is, does this invert? Does the right hand of this end up being lower than the left hand, which we have a minor inversion here right now that we can see. Those inversions have been a fairly accurate predictor of market recession over the last 100 years. Now, that doesn't mean the recession happens right now. It typically precedes the recession by about 6 months. So what this is saying is maybe watch out for that. We'll see if this continues to steepen, right? But that's dynamic yield curve. It's a intermarket relationship between the different yield rates for the yield rate for the different bonds. Okay, these are all U.S. bonds, right? Then we've got Dow theory, and that's looking at transports, the Dow transports, and how they behave in regards to the overall Dow industrials. Okay, and we can see this if we go to the market breadth link here. What that's going to bring us to is a shared chart that has a bunch of these different intermarket ratios in here, and I need to find it really quick. It's in the list, I'm fairly certain. It's Dow Gold, dips and tilts, advanced decline. I thought it was in here. Is that this one? Let's see. Here we go. So this is where we're looking at the IYT is the I think the IYT is the transports. Yeah. So the IYT is the transports, and the Dow Industrial Average is the industrials, and we look for how these two relate to each other, right? Is that right? XLY. Hang on a second, I gotta look really quick. IYT. Yeah, that's the transports. Okay. I don't know why I get confused about that, but I do. Okay. So we look at this and we see how are these two things related to each other. Okay. Is one going up while the other one's going down? That becomes really impactful and relevant. So that's Dow theory. When we talk about Dow theory as opposed to the Dow Gold relationship, Dow theory is about transports versus industrials. Okay. And then we have market breadth. Now, market breadth is in here. That's what we can look at a few different things. Advanced decline line's one of those. But honestly, most of the time, now that it's up and running, where I like to look at that is on the main site, right? So if I go to, and this is part of my process, right? This is one of the things I look at in the morning is I look at the market breadth and broadly, and I also look at the crypto breadth. You can see them there, but you can also look at them in here. Now you will, in order to get to the breadth, I think you have to pay for the package that we have for this, but Brian also goes over them in the daily brief. But I'll look at the S&P 500 one. Here we go. I look at the S&P 500 breadth for myself, and I look at the crypto. I'll look at both of these, both the top 30 and the crypto universe breadth, to get an idea there for my crypto trading. So that's another thing we look at. Look at the different, I don't know if sectors is the right word because we have like index ETFs in here, but we try to look at where money's flowing, right? And then we get some information from derivatives as well, and you'll see that in here. I think we've got that in here. Well, these are the sentiment indicators that we were talking about during the sentiment indicator week. So this is all information we get that. There is some other derivatives information that we get that we won't really go into in level 1. In level 2, we'll talk a bit about the COT report and that stuff, and that gives us some other additional information that we can pull from derivatives. Now, how do I use Intermarket Analysis? So at the beginning of each my day, before my trading session, I review news. Right? I like to use the TRI News dashboard. I'm really glad that they pulled this together because I got tired of aggregating multiple different news sources manually. There's other ways to do this as well. Like for a while, I had, what's that called? There's an RSS aggregator that Google put out, and I used that for a while. But this is easier because I'm on the site anyway. So come in. I'm just looking at upcoming news. The other thing I look at is I'll look at, there's a few different sites, but I like Econodays best. I'll look at upcoming events for the week. I'll come in to view full calendar, and it will show different events that are coming. It has like a little red mark next to ones that are particularly impactful on the market. Right. And so I'll review that, say, okay, well, what kind of news do we have coming up today? I will also review, like I said, the market breadth for the S&P 500 and for crypto. And that's something, these are things I do every day when I'm beginning my day. So that's how I use it. How are you going to use it? Well, as with all things, it's a matter of personal fit. It's important you understand that both range trading or bottom and top fishing and momentum plays, where you're playing the middle part of the run, they're both right. You know, whichever one you are more comfortable with, go for it. I do both. You're gonna hear that a lot with me. I don't like to limit myself, so I'm going to teach you a setup that we use for range trading called the 3-step setup. I'm going to teach you a setup that we use for momentum plays, which is the one that we saw earlier. It's called the bot. I'm going to teach you a setup that we use for pretty long time frame kind of position trading that I call planting flowers. That's my little old lady based setup. You'll learn what that means. I think next week we're talking about risk, so you'll learn about little old lady next week. Remember to layer your analysis, right? Your technical reasons should be as unrelated as possible. Generally at TRI, we divide our technical reasons into location, which we're going to learn when we get into fibs. There's some other location reasons you'll learn in level 2 and 3. But for level 1, it's pretty much fibs, and we'll teach you how we use those. A couple different ways to use them. Then momentum signals. So that's all your indicators. That's like MACD and Willy and OBV and RSI, right? And then price structure. And that's where we're looking at those market and transition patterns within price. Those are generally how we divide our reasons, right? Reason 1, reason 2, reason 3. That's our technical reasons. Typically, as we said before, we like to be rational analysts. So we're going to have fundamental reasons baked in because of our fundamental screening. So that's how that all comes together. That layered analysis is really important. All right, so that is the presentation. Let's take a look at the quiz. All right. Could you explain how you read the breadth indicators? Actually, it's pretty simple. Brian can talk about it in more depth in the BCS. Peter, that's a good call. Ask Brian about it in the BCS. But generally, what I'm looking for is what is the fast signal doing in relation to the slow signal? Have we had a cross with it? And then do we have any kind of market structure showing itself in that signal? Okay. That's what I'm looking for. All right. Is the Super Bowl a key crypto event? Well, we'll get into liquidity events in week 11. And we can ask me again then. All right. There are how many schools of primary schools of technical analysis? There are 3. The Dow Gold ratio is an example of which school of technical analysis? We're looking at intermarket relationships. right? Skyfire, what you got here? Is this how we should be thinking about price, indicator, convergence, and divergence? No, not exactly. So when I'm looking at bullish signals, what I'm considering is what is lows versus lows doing. Okay. When I'm looking at bearish relationships, I'm looking at what are highs versus highs doing. So, in other words, if I am looking for bullish convergence, I am looking for higher lows or bullish convergence. I am looking at higher lows in price and higher lows on the indicator. If I'm looking for bullish divergence, I'm looking at lower lows in price and higher lows on the indicator. For bearish, bearish convergence, I am looking at lower lows in price and lower highs in price and lower highs on the indicator. For convergence. For divergence, I am looking at higher highs in price and lower highs on the indicator. Okay. The two primary market states are ranging and trending. Okay. And then markets tend to range about 70 to 80% of the time. And that's on a given time frame. Remember, we talked about how within a given trend or range, we're going to see smaller scale ranges and trends as well. Okay. So on a given time frame, we see markets ranging most of the time. And what ranging means is just that price is found in equilibrium. And equilibrium is not a single point, but a range of prices. And so price will move in that equilibrium level until a new fundamental event happens. And at that point, we typically move to some kind of trend, either up or down, where we're seeking the new equilibrium range. All right. The term used to describe the change in a market from one state to another. Yeah, as Brian says, we will spend a lot of time on indicator signals and divergence. All right. The term used to describe the change in market state from one state to another is called market structure. Okay. And then the three primary trend change formations taught in this course are M's and W's, heads and shoulders, and triangles. Indicators measure which two key internal technical gauges, oscillation and momentum. And an indicator can be, I would say all indicators are momentum indicators. Some of those can be are oscillators. So an indicator can be both. Right? An indicator is said to be what when it is not making new highs, but the price of an asset is moving to new highs. It is in divergence. And then technically speaking, two stocks that move very closely in price are said to be highly correlated. And assets can move into and out of correlation. Stocks and bonds usually move the opposite direction, which means they must be inversely correlated. And then which of the below is an intermarket analysis relationship? Oh, excuse me, guys. Well, we know dynamic yield curve is. We didn't really talk about futures term structure, but futures term structure is the relationship between like a 3-month future and a 6-month future, right? So that is an intermarket relationship. Dow theory certainly is. That's the relationship between Dow transports and industrials. and then market breadth is. So all of the above. All right, technical analysis is a proxy for what? Technical analysis really is a proxy for supply and demand in the marketplace. I guess we didn't talk too much about that, but that's what it is. And we did talk about this. Technical analysis works best in the absence of new fundamental drivers. That thing where we find equilibrium and then a new fundamental driver comes in and that moves us off of that. Yeah, sorry, Fresh. Didn't mean to just spread the yawn there. All right. Technically speaking, why do markets range between 70 and 80% of the time? I've talked about this a couple times now. Equilibrium levels in supply and demand have been identified, and there are no new fundamental drivers. So that will just make price oscillate between these two levels. And then what technical indicator do we use to confirm market structure and patterns such as heads and shoulders, M's and W's, and triangle patterns reviewed in the course video material? And that's volume. We didn't really touch on that too much in my talk, but Brian goes over it in the video a bit. So. And we'll learn to do some more advanced volume analysis as well once we get into the candy store fully. And then one of the key uses of indicators and the concept of divergence is to use the concept of divergence really to tell us about what. And we're using that to tell us about future price action. Remember, these indicators that we have are by nature lagging indicators. They have to be calculated off of the price action that has occurred before. And the way that we can take that historical data and project future data from it is through the use of divergence. And then what is the ultimate fear proxy, as well as a good sentiment indicator to be aware of in the market? And that is the US dollar index, the DXY. And then in building your TA toolkit, as a trader or investor, what is one of the most important concepts to understand? And that's that it is all about personal fit, right? You're only going to use the tools you're comfortable with, that makes sense to you. So you're going to build your tool belt from that. Does that mean we don't seek out more information about the things we don't understand? Of course we do. But that's how we build it into our toolkit. All right. The definition of an uptrending market, also called a bullish trend, is higher highs and higher lows. And then the definition of a down or bearish trending market is lower highs and lower lows. It's surprising how often this is going to come up, and don't feel bad when it does. It's very, very common. As we go through and we're practicing with identifying market structure, I have to reiterate to people very commonly, remember, this is a transition into a trending state. How do we define trending states, right? All right, so there's our quiz. Let's take a look at the Q&A doc. Divergence. Is this definition true if one is moving slower, or does one have to be moving in the other direction? So I'm not sure what you mean by slower or faster here, but the whole concept of divergence is that we're looking at price moving in one direction, right? Trending up, trending down, while we see the indicator moving in the opposite direction. These are the times when we have a higher statistical likelihood of price reversing to move in the same direction that the indicator has been moving. So there's not really any slower or faster. We literally just want to see opposite trends. Somebody asked, how do double tops and double bottoms work? So I'm really not sure what you are asking here. One of the other students did provide some links, which is really nice. Good job. Thank you. To this, the book Spotting Profitable Timing Signals and Technical Analysis of the Financial Markets. These are out of the library. So, yeah, really good books. They will talk some more about that, but I'm not sure exactly what you're asking. Maybe you're asking how we define our risk and how we use this to enter trades, in which case I did cover that. So, Um, when looking for triangles, double bottoms, and double tops, how are the different time frames used? So I did talk a little bit about how I use anchor charting. And we'll talk some more about that when I get into fib retracements, because we use fibs usually on a larger time frame when we're doing our anchor charting. But for now, I would just focus on identifying these patterns on whatever your chosen time frame is. Can you make an example of drawing the 3 triangle tips? Sure. Let's come over here. I think you mentioned BTC, so let's do it in here first. All right. It's triangle breakouts. Okay. Let's see if we can find a good one. So, there's a few different ways of drawing it. I'd like to just use the trend tool, right? We got here. We got this triangle here, and if we'll just go flat there, come up here, and this is what we have, right? We got a triangle here. Well, you'll start seeing them all over the place too. Just start drawing them out, right? Here. Right. Kind of a symmetrical triangle breakout here. A little bit descending, but I don't know if we could say we have the same level, but I guess if you went back to here, it'd kind of be the same, right? Ironically enough, this leads to this other triangle here. So yeah, just use this this tool here. So you'll see this in the upper left. You'll see that mine is set so that it extends to infinity on the right. You can just come into here, and under style, you can say extend all the way to the right. You can say extend all the way to the left. Give me a middle point so I can see where that's at. Get a lot of good detail from it. It's kind of handy. Okay. What is the best symbol to use for the US dollar index? I just use the DXY. All right. In the mall example, the technician sees who goes into what stores. Would this be akin to betting on sectors to follow rather than the specific stocks? At the risk of overusing the analogy, we'll get into sector rotation when you get to level 3. But I'd say that's where you get into looking to the discount section and looking at winter coats in the summer and bikinis in the winter. So, all right. Is the symmetrical triangle pattern the same as the megaphone? No, it's basically the exact opposite. So, let me see if I can find you a megaphone here. Is that a megaphone? I don't know. Not really good at identifying megaphones. I don't typically trade megaphones, and they are extremely difficult to trade. So we don't really go into megaphones in level 1, but I do want to see if I can give you an example of one. No. I can't really find one right now, but basically, with a megaphone, you are looking at periods of higher highs and lower lows. So I'll just draw on the empty space here. With a megaphone, you're looking at higher highs and lower lows. Okay, so we're looking at price moving in progressively wider moves, right? That's a megaphone. A triangle is exactly the opposite. In a triangle, you're looking at symmetrical triangle, we're looking at lower highs and higher lows. And so we're looking at price compressing, getting tighter and tighter till it breaks out, right? So kind of the exact opposite. Ascending and descending triangle patterns have to be exactly a horizontal line. I wouldn't say exact, but you do want it to be close. You're effectively defining a level of support or resistance. There'll be more of that in level 2. So you want to see when that's broken through. But that's not usually a specific, like, this very specific price. It's typically more of a range of prices, right? In fact, you might want to specifically use the parallel tool to define your range that you're looking at. If you're drawing it on a chart and you're looking at a ascending or descending triangle. Okay. But generally, yeah, we want it to be flat. Because what we're wanting to see is a test against it, and then moving up. So like a descending triangle, we want to see a test against the low, then move up, but not move up as high, and then another test against that same low, move up, but not as high as the last one, another test against that low, right? All right. Indicator analysis slide. In the RSI indicator, Brian drew a W and a circle pointed that corresponded to the RSI. I thought in the W, the low should be touched twice. I didn't see that. When he finally said this finally signal trending up, I didn't understand how he determined the double bottom and what signal it received. So generally speaking, with a W, we actually want to see the second low higher than the first, right? So if we're looking at a W, what we really want to see is something like this, right? Where we have the second low higher than the first. Remember, we're moving into a bearish or into a bullish trend, so we want to see it move into higher highs and higher lows. Now, we don't necessarily want these really far apart, and there's a reason for that as a trader. Remember, if we get into a trade off a W, we need to risk to a break of this lowest low. So if they're really far apart, that can put a really high degree of risk that we have to put in, which means we commensurately need to expect a pretty high move in order to justify that trade, and that can be pretty hard to achieve. Whereas if they're pretty close to each other, right, particularly if the midpoint is also pretty close, because if the midpoint's way off, that's going to be a problem too, right? Because we're confirming way up here. But if we have the midpoint and the right-hand low relatively close but higher than that left-hand low, that's ideal, right? That's what we want to see. And ideally, we really want to see this wide, right? The wider a W, the more confident we typically feel about it, right? If we've been consolidating for a while and building up pressure, when we break out, that breakout is usually pretty good. So, hey, Eddie, that was a good megaphone that you drew there. Thank you. That's exactly what I was looking for. Like I said, I don't typically trade megaphones, so I don't spend a lot of time hunting for them. So, good either. That's exactly right. All right. All right. Where was I? Okay, so hopefully that explains what we're looking for. What we're looking for is the confirmation level for that W, right? And that W confirmation is going to be when we close above the midpoint of this W. So that's the point at which we have lower or higher lows and higher highs. Remember, that's what it's all about, is moving into that that trending state. The course material says not to have a position heading into a key news event. Is there any news or website source for those events for different kinds of assets. We'll get into that in week 11. That's specifically what that week's about. The short version is Econoday's got a pretty good idea of the broader news events, but there's also some things that have to do with individual assets, right? Happenings when it comes to crypto, earnings announcements when it comes to equities. Oil has its own, each commodity kind of has its own thing, right? If market structure marks the transition from one state to another, ranging to trending, vice versa, then why do we look for market structure to confirm any given setup? I.e., since a given setup, like a 3-step setup, works best for a ranging market, if we enter in the presence of a market structure, wouldn't that indicate changing market state and thus invalidate the premise of the setup? Well, so first of all, and this is important, a 3-step setup works best in a trending market, not a ranging market. Or sorry, I was thinking of the bot. The bot works in a trending market. You're right. The 3-step setup works best in a ranging market. Now, what we are looking for, market state isn't uniform across time frames. What I mean is that we can be in a bullish trend, but within that bullish trend, we can see pullbacks, right? So small bearish trends. That's what I was talking about with the trade that the bot trade that I took earlier, or this last week. When we look at trend continuation setups like the bot, we're looking for the pullback to certain levels. Overall bullish bot, we'd be looking for a bearish move down to that range, followed by a reversal to a larger range. And I misspoke here. Is for a ranging market. So ignore this last part. That is okay. So it's funny. You can tell I was tired because like a 3-step step's not used for that. We use a 3-step step for that. So when we are looking at a 3-step setup, okay, what we are looking for is we're looking for a ranging market, right? So we have defined kind of our boundaries, and we'll get into fibs in a couple weeks, and this will make more sense as far as the fibs at that point. But then we need to get into this reload zone for us to get a short position on, right? So that means we have to have a bullish trend on the shorter term basis to move us up into that. That range consists of a ranging market, right? Consists of an upper boundary, right? A lower boundary, and price moving between that upper boundary and lower boundary. Those moves are bullish and bearish trends on that shorter period of time. That doesn't mean we're not in a ranging market state. We are, but each of these market states is on that shorter duration this is a bearish market state, and then we transition from this bearish market state into a bullish market state, into a bearish market state, into a bullish market state. Okay, that's what a range is. Hopefully that makes some sense. I like that somebody's marking the need for this. I really need to figure out how to put the timestamp dividers into my YouTube videos. I'll work on that this next week. See if I can figure that out, because that'd be really handy. Okay, given that we use volume to confirm market structure, does that mean one of the 3 reasons has to be a volume indicator? No, that's a different thing. So we'll learn about volume indicators, specifically OBV, and how we do that analysis in week 8. We are just saying that when you have the market structure and we have some significant trading volume, so we have a spike in volume at the end of that market structure confirmation, that can give us confirmation of that market structure signal. Very simple. When we get into more complex volume analysis in week 8, you're going to learn some more stuff there. Can you elaborate on confirmation by a higher time frame, how that works? Do we start with analyzing a higher time frame chart, confirming the market structure on all excuse me, subsequent lower time frame charts, or do we go through each time frame chart until we find the confirming market structure? So the idea behind using multiple time frames is we look at the higher time frame first, identify the trend for that higher time frame. Then we move into lower time frames, and that's where we hunt the setups in the same direction as the larger time frame trend. I call this anchor charting. I don't know if it has an official name. I did link to an Investopedia article on it here using multiple time frames. But generally speaking, we start on the larger time frame, we look for trend there, and then we hunt for our market structure. Well, we hunt for our setups, which have as an element in them price structure. Okay. Remember, it's a little more complex than just look at a larger time frame and then look for market structure. We're looking at a larger time frame, and then we're looking for, on the lower time frame, all the components of our setup: our location, momentum, and market structure. Okay. Is it fair to say that for some assets, ranging markets have trends embedded in them and vice versa? Yep, absolutely. For example, in this BTC-USD chart, the trading range seems to have been established by an upper and lower price boundary, and price oscillates between these two extremes following bullish and bearish trends. Look at the chart. Yeah. Yeah, that seems legit. If so, how can we claim the market trends 25% of the time and ranges the remaining 75% of the time? So what you're talking about here is as you look within that range, you're seeing these trends. So how do we say that this is not trending during these times? Well, we're talking about on a given time frame. So on this overall time frame, we see that we are in a ranging state. A ranging state does not, being in a trend on a lower time frame, which is what these are, right, does not mean we are not in a range on this higher time frame. So on a given on a given time frame, we tend to range once we've found those points of equilibrium. That's basically what we're saying there. With that said, I'm not sure where that truism originated, the 70 to 80% ranging truism. I'll see if I can hunt a source for you, but I haven't found one yet. In practice, I can't say that anecdotally I found this to be true. The markets tend to find equilibrium levels, and we can define those levels, and I use those in practice to trade. When we get to the extremes of one of those levels on the range, that's where I look for a reversal, and I can hunt there pretty effectively to find and take advantage of that ranging back and forth. So. Steve says to have video chapters in your video, you just have to write it first and things. So I just write it in the description, and then that will put the timestamps in. No chapter should be less than 10 seconds. No typos. There's a probability they will not provide it to you. It's not a sure thing. Oh, that's weird. Huh. I'll check that out. Thanks, Steve. Appreciate it, man. Kelly says, how do you separate flags from triangles? We don't get into the whole bear and bull flag thing in level 1. Kelly, we actually don't do it in the course. How do I chart intermarket analysis? I'm not sure how to get more than one asset on a single chart. Dow gold ratio or Dow industry transports. There's a couple different ways to do it in TradingView. So if you are looking at an asset, let's look at whatever, Tesla. Okay. And I wanted to compare this with I don't know, Ford. Okay. I can compare it on the same chart by just coming here and typing Ford. Okay. When I do that, it will change this scale to a percentage. If I wanted to have this be a regular scale, they're going to be pretty far apart because the pricing's pretty far apart, right? If we do it as a percentage, then we can see it there. I'm not sure what index to 100 is going to do. I think it's the same, basically. Yeah. So that's one way of looking at it. It's literally on the same window. You can also come up here to the Ford because it adds that as an indicator. And you can say, I want to move this to the new pane above. And then you can go bring these back to a regular price scale. And then you can view them both. And you can expand this out. And you can look at this as candlesticks. And basically kind of do an apples to apples comparison, right? So we can follow what are they doing respective to each other, irrespective of price point, right? So that's one of the ways of doing that. If you have a paid account at TradingView, you can also come up into here and they have split panes that you can do. So this is what I was talking about earlier with the time frame thing. So I can come in here, I can be like Tesla, and I can, for instance, let me change this to candlesticks. I can do on the left-hand side, I can say, I want to see this on a daily. And on the right hand, I want to see this on a 30-minute. Okay. And if I come up into here where I selected this, I can say, okay, I want my crosshairs to be synced up. See what's happening there? I've got my crosshair on the right-hand side, but on the left-hand side, it shows where it's at on that larger time frame. I can link my symbol so that if I change one of them, it changes both of them. So now if I go to SPY, then I'm looking at SPY, 30-minute and 1 hour. So that's another way that we can go about that. But you have to have a paid account in order to do that. And I think depending what level of paid account, I think it exposes different scenarios, like for splitting the chart up. So. All right. Would you please provide chart examples of the 3 combinations of divergence? So I think I saw where you got this from. I think how Brian describes divergence makes it sound like there's these 3 different combinations. What we're really concerned with for our purposes is divergence between price and an indicator. That can be a price indicator or it can be a volume indicator. But what we are concerned about is divergence between the price and that indicator. Okay, you're going to learn about volume analysis later on when we get to week 8. But even with that, when we're looking for divergence, we are looking for divergence between price and that indicator. Okay. And then where can I find market breadth, 52-week highs versus lows, indicator mentioned in the course? I think stockcharts.com is probably your best bet. They've got a link to this index, which is this index, the way that it's created, which is this line here. These other 2 lines are moving averages on it. But what this is those stocks which are at their 52-week highs divided by the sum of the 52-week highs and 52-week low stocks. So it's kind of an interesting index ratio, right? So that's where you find that. I don't use it that much, like at all, but doesn't mean you won't. So there you go. Can you provide an example of how you integrate intermarket analysis to your tactical trading plan? I did just talk about that. So At the beginning of each day, I review my news stories. I review market breadth, both for the broader market and for crypto. There's a few other things I review that we're not going to learn in level 1. They are technically intermarket, but I look at some things that come from derivatives. Specifically, I'm looking at max pain, and I look at the close versus settlement price. It's not really intermarket, but max pain is for sure. Can you go deeper into this PDF statement about momentum indicators? Very much like price, when an indicator moves to new relative high or low, its underlying momentum is considered confirmed. That's where all we're saying here is we're looking for those that market structure to be confirmed in the indicator to confirm momentum. In other words, if we are looking at momentum and we are, I got rid of my RSI. If we are looking at momentum and we are looking at momentum being bullish, we want to see confirmed W's in the indicator to confirm that trend. Okay. The lecture mentions 3 reasons, being location, momentum, and price structure. Where does that leave oscillating indicators? Oscillating indicators fit into our momentum category. So our momentum category includes all of our indicators that we're going to be using for that setup, right? So for my 3-step setup, I look at the Willy, that's my oscillating indicator. I look at OBV, that's our volume momentum indicator. I look at MACD, that's a raw price momentum indicator, and I look at RSI specifically as a raw price momentum indicator. And I have some methodology around that I use, where I adjust the size of my trade based on how many of those are giving me a positive signal. So basically, as I'm doing my analysis, each of those factors, location, momentum, and price structure, has a sufficient definition, and it has a good definition. If it hits good, then I add a percentage of risk to my trade, starting at 0. And if it is sufficient, then that's enough for me to move on to the next thing. And I look at those categories in a specific order. I always look at location first, then I look at momentum, then I look for price structure. Okay. Get my head around market breadth, put call ratio, and volatility index. Can you show us how you personally use them? Oh, you know what? I didn't touch on this too much. At the risk of making things confusing, I can show you my day trading layout. The reason that's relevant is because I'm specifically using volatility in here. Okay, so there's a lot going on here. I'm sorry, it's pretty busy. But on the right hand side, I've got like these are all hourly, so this is giving me my broader view of the market. It's hourly, and I've got volume profile on here, which you won't learn till level 2. And then on the left, this is the chart I'm actually trading on. So this is a shorter time frame. And up above it, I've got the volatility index. So when I see a move happen here and I don't see a corresponding adjustment to volatility, that gives me pause, right, in trusting that move. So that's kind of how I use volatility. What are the other things you asked about? Put call ratio, volatility index. I don't use the put call ratio as such. So put call ratio is talking about predominance of puts, which are bearish bets, and calls, which are bullish bets on an underlying asset. So I don't really use those. I do look at market breadth, and market breadth I use in a pretty basic format. I'm just looking at the relationship when I look at the market breadth between the fast and the slow signals. For instance, if the fast is moved above the slow, that's a bullish sign. I really want to see some structure coming here. Like I want to see this a W like we have here. Conversely, if I'm seeing it cross the slow up here and it is making an M, which we have here, that is a bearish signal, right? So that's what I'm looking at with market breadth. It's just giving me an idea of broadly what are we seeing, okay? Hopefully that helps a little bit. And then what is the difference between market breadth that Brian teaches in week 4 and the paid one on the TRI dashboard? So Brian's developed a multi-time frame algorithm. I believe it's based on his Delacour index, which you learn more about in level 2, for looking at markets, and that's what's summarized in the dashboard. He can talk about more in the BCS. He knows more about the internals of it than I do, right? And then what are proxies? The homework question mentions charts on proxies. So proxies are just assets that represent other things. So industries, classes, they represent batches of things, right? So when we look at gold as a proxy for commodities, we are saying that how gold behaves is how we're expecting commodities in general to behave. That's what we mean by a proxy. All right. Does a W or M in the OBV or Willy indicator count as confirmation of that indicator? Do we always need divergences or to take a trade? It depends on the type of trade. For the 3-step setup, which is a ranging trade, I always want to see divergence. For the trend following trades, like the bot, I actually look for convergence rather than divergence. As to do we need to see a W or M in OBV or Willy? Yeah, I always want to see a W or M because I want to see a move into a trending state, be that bearish or bullish. I don't. You might be picking up some background noise on my end, so sorry if the keyboard typing's a little loud. So, all right. We touched on this. All right. Oh, weird. This seems to be moving with me. The U.S. is not like Japan. What does that mean? You got to give me more context. I don't know. I don't know what you're talking about there. If you can give me like a timestamp in the video, I can speak to that. All right. What does relative inelasticity of demand mean? So elasticity of demand means that as the price changes, right? If the price gets too high, then demand can drop off. However, there's kind of a baseline of demand that's needed. So, or not needed. There's a baseline of demand for any asset. And that's the point at which that becomes inelastic. In other words, the demand stops dropping at a certain point because that's just what they need regardless of what the price is, right? Think of things that you have to have, right? Healthcare. Healthcare has a very low inelasticity of demand. When you need healthcare, you need healthcare regardless of how much the price is. Price isn't going to change that demand very much, okay? Whereas the need for fast food, right? That demand can drop as the price of fast food gets higher because it's not a necessity, right? It's not seen as a necessity. What are tips and tilts? So the TLT is an ETF, right? It's specifically the 20-year U.S. government Treasury bond, and so that describes the. I might have this backwards, but I believe that describes the yield for that bond. The tip, just tip. The tip is the inflation adjusted 20-year bond yield. Okay, so we're looking at inflation adjusted versus not inflation adjusted. Brian's got a whole video on tips versus tilts in the library. And where are we at? Library, that's what I was looking for. So somewhere in here, we've got an article that Brian did, a video he recorded on bonds. I'll see if I can dig it up later. I don't remember where that is at. So I'll look for it later. I'll post it out to the class chat. All right. When looking for a confirmation of a breakout or breakdown, does the price have to close at that higher price in the case of a breakout, or exceed the price at any point in that time frame? When we're looking for the confirmation of W or an M, I want to see the price close beyond that midpoint. Okay, so while I will use wicks and tails, that's wrong. While I will use wicks and tails to define that, say W, right? Like I have here. So boom, boom, boom. See, I'm going to the tail. I want to see a close. So this is not a break of it, even though this high is here, because the close is not here, right? The wick, it's not counting for that. This is my close. I have a close beyond the midpoint, right? So I do need a candle body close beyond the midpoint of that M or W to confirm it. Skyfire, let me hit that after I get through the rest of these core questions here. For descending triangle, could this lead to a breakout, or is a descending triangle generally bearish? A descending triangle is generally bearish. We're looking at a specific level that's being tested against, and it finally breaks out. For the symmetrical triangle, that can go in either direction. But for a descending triangle that is generally bearish, an ascending triangle is generally bullish. Can you explain market breadth? I think we said earlier, ask about this in the Broiler Chicken Show. Brian can probably talk at more length about it. Theo says he thinks that videos in the How Markets Work subheading. Yeah. So if you go here to the bond and bond spreads specifically, that bond spreads video is pretty rock solid that Brian put together. So. All right, technical analysis defined. Example of Roy Disney. Not sure if I got the example 100%. Do I understand correctly the rumor that Roy Disney having to sell Disney block of shares being under pressure drove the price on the market down? Yep, and that's considered a fundamental event. It absolutely is a fundamental event, which led to fundamentalists being happy that they got to buy Disney stock undervalued. How about those technical analysts then? Did they have a difficult time because their price chart and volume analysis did not predict this? They got screwed. It depends on the technical analyst, right? Different models will work, but generally speaking, when we have fundamental events like that, yeah, the technical analyst could get screwed. That's why we have stops. Brian refers to convergence as the moving in unison of price, volume, and momentum. In Investopedia, convergence is defined quite similarly. However, it seems to be limited to futures contracts. Interesting. So for convergence, we're just talking about when price and the when price and the indicator are both moving in the same trend. Okay, so if you're bullishly trending in price and you're bullishly trending in the indicator, that is convergence. Take a look at this article you found. Yeah, this is a different thing entirely. This is talking about futures convergence. Futures convergence is a different thing. It's just talking about the spread between the futures contract and the spot price, which is one of those intermarket relationships that we keep an eye on. And it's talking about those coming closer together, those converging. When we talk about convergence, we are talking about simply that the price and the indicator are moving in the same trend. Could you talk about the difference between a descending triangle and a falling wedge pattern? We're not getting into, I mean, they're basically the same, but we're not getting into falling wedge patterns. That's not what we're doing an analysis on. So just stick with the stuff we're teaching you in the course. Pulling this into falling wedge, they're similar but not the same. Okay. Oh, you put your question in the Q&A. Perfect. All right. Well, then I'll get to it when we get there. Grimm, how long does it take you to go through your pre-flight checklist in the morning? We are pressed for time. Or any sections you are willing to reduce or skip. My morning ritual takes about 30 minutes. If I'm pressed for time, honestly, I'd rather come into the market late or skip a trading day than rush through that process. It has bit me in the butt when I have tried to short circuit it. So, can you explain the concept of correlating and non-correlating markets? So some assets are driven by similar factors and tend to move alongside each other. We call that correlation. For example, many of the stocks in the S&P 500 are correlated with each other. There's a measure of correlation which exists called beta, so it's a mathematical measure. In the industry, the default beta measurement is against the SPY, but you can look at beta between any two assets. But when you look at beta like on a site, that's going to be the measure of correlation with the SPY. So when we look up the beta on a stock in FinViz, so if we come out here to FinViz, we can look at like, oh, I don't know. Let's look at Tesla. So Tesla has a beta of 2.04. That means for every dollar that the S&P 500 moves, that the SPY moves, we typically see Tesla move $2 in that same direction. If this were a negative number, that would imply that when the S&P 500 index ETF, the SPY, moves up $1, we would expect that asset, if it had negative beta, to move down $1 if it was a 1-to-1. So there's a specific measure that talks about and I think it's averaged over the last year of data, I want to say. So over the last year, that's how that's performed. That's what that beta measures. It's all versus the SPY. But depending on your platform, or if you can even calculate it manually, like in Excel, there's actually some videos out on YouTube about how do you calculate a beta using Excel. So you can calculate that beta for different assets, and then you have a mathematical measure of their correlation. Okay. Those beta ratings, incidentally, and this is important to note, are typically done off of daily price movement. So that correlation may or may not be not true on a lower time frame. If you're looking at a 4-hour or an hourly basis, that correlation really isn't calculated on that basis. So you might have one asset, you might have two assets, both of which typically move up the same amount in a day, but one of them might, during the course of the day, have a lot more wild gyration than the other. Right. There are some measures for that you will discover when you get into like level 3 option stuff. There's some measures for individual volatility. So, okay, that's where I was. Could you dive into more details about your Sunday FA screening process? What criteria do you use to filter the hundreds of results from those screeners into the dozens we followed through the week, and what signals do you look for to judge whether a setup fired? So we'll get into more of that once we get into the candy store more. I can't really show you right now without explaining a bunch of material that we're going to cover in future weeks. So just hang tight. The short version is I look for good location. That's easy for me to filter by. Momentum and then market structure reasons. Oh, excuse me, guys. But that won't mean a lot until we get to the course material. Okay. Can you show us how to screen for VCIM? I was trying to put that together, but I haven't gotten that done yet. So I will continue to have this highlighted, and I will see what I can put together for you during this next week. Is there a natural association between FA screeners and setups? For example, would WDB work better for screening assets better suited to planting flower setup instead of CanSlim? I haven't noticed a particular correlation, but honestly, I haven't been looking for one. Keep an eye on it during your paper trading. Let us know. All right. What is the Holy Grail? In trading, there's this common misconception that if you can find the perfect setup, you'll be able to just print money and never have drawdowns. That's referred to as the Holy Grail because it's not realistic and people will spend their lives in pursuit of it. Okay. In reality, it's our behavior and our risk management that makes the biggest difference in our trading success and failure. While edge does play a part, it's very overstated in the minds of many retail traders. Okay. In real trading, not paper trading, how does the 2-to-1 ratio work on crypto? Maybe it doesn't. I'm told that when crypto coins are sold, even if I am the only one selling, I drive the price down. That's not true. For example, if I sell off all my SHIB coins, the resulting price would end up being less than 2x and maybe even much less. From a real trading perspective, does this matter? Because the question should be, did you follow your setup? If it does matter, then you have to wait for 3-to-1. In general, with a setup, when you're in it and you have your price target is where it is. Okay. Even in crypto, retail traders generally aren't the ones moving the market, right? There are whales out there. There are big institutions out there trading even altcoins, okay? Those are the people moving the markets. You're not going to be appreciably moving the market with even a couple $1,000s, right? If you start getting into the hundreds of thousands of dollars and you're talking about a relatively illiquid market, sure. When we sell as retail traders, we simply put our limit orders into the market. When the price moves to those levels, they get filled. Okay. We're not generally doing it as a market sell. We're doing it as a limit sell, which means they get filled at the level that we have it set at. Stops we often will do as market sells because we just want to get out of the position if it's moving against us. Those can have slippage, but our limit sells are going to sell at the price they sell at, like the price we set. Now, when we sell in illiquid markets, now this can come up with DEXs, we can see order slippage if we use market orders. We might not have an option to not use market orders, but that's one of the reasons we want to make sure that we're operating in as liquid of markets as we can bear. And preferably, we're using limit orders rather than market orders for our take profits. It's also important to understand the 2-to-1 risk to reward ratio. we use that to evaluate whether our setups are validly firing. So if I'm looking at a setup, right? Where's that? Yes. Okay. Let's look at. So when I did this setup, one of the steps that I have in here, 5-minute chart, is when I draw. Well, it's 3 minutes I went on, but when I set this setup up. So here, when this had fired, I put my order in to sell at this level. Okay. And when I did that, I put this this drawing on that showed, okay, here's where I'm looking to enter, here's where I'm looking to stop, here's where I'm looking to take profit. And one of the last steps I do is I look at that and I say, okay, is that risk reward ratio at least 2 to 1? Now, I didn't place my target based on a 2 to 1. I placed my target based on something we're going to learn called an ABCD. But I need to evaluate that and make sure that, because I have a rule that says it has to be at least a 2 to 1 risk to reward. So after I've figured all that out, I look at that and I say, okay, is that at least a 2 to 1 risk to reward? Okay, it is. Then I can go ahead and put my order in. Okay. So it's an evaluation check for us. Now, in some setups, you're going to place your take profit at a 2 to 1 risk to reward. But in most setups, you identify your take profits because of other reasons, and then you want to evaluate to make sure they're at least a 2 to 1 risk to reward. All right. Related to your answer to question number 6, is there a market cap or volume value we look for to operate in different assets? I mean, for do not buy crypto with a daily volume below X. I haven't really looked at that. And don't we affect price with our orders of maybe $100 to $1,000, even with those cryptos with very low volume? Not as much as you might think. I have very, very rarely seen market moving as a result of my orders. Now, the market can move at the same time I'm placing an order, but that doesn't mean those two things are necessarily related, right? If you're trading very illiquid markets with very small caps and you're trading in a large size, and we're talking about much larger than $1,000, then sure, you can move the market, but that's going to be pretty rare in most cases. Grimm, out of curiosity, given what Brian said about shares outstanding in the FA lecture, why didn't you constrain your FA screeners by shares outstanding? Is there a particular reason you'd look at all the assets being the criteria rather than the ones with the fewer shares outstanding? Who says I don't? I talked actually about this last week, that my customized GARP, cancel, and WDB screeners do include some other factors to limit them. And you can certainly do that on your own. I want you to be able to customize these. Remember, we're giving you the base tools, but we want you to customize them. We want you to make them your own. Okay. All right, what could cause an asset to gap in prices like this? So gap theory is really a level 2 concept, but I do want to talk a little bit about it, right? There's a lot of reasons that can cause a gap. In the case of equities, gaps can occur overnight. I think that was an overnight and early morning news story. Gaps that occur overnight are often caused by news. In this particular case, HMLP cut its dividend payments by 98%, and the news of this came out after hours. This resulted in quite a bit of selling as soon as the market opened, which led to that gap. But at its core, a gap down is just caused when there are sellers who want to get rid of their shares and they're willing to market sell them, but there's no buyers except down at lower levels. Okay. That means price is going to move down to those levels, because the price that you're seeing on the chart is just where did the price transact. If you've got people up here, they're like, we want to sell, who's going to buy these, and we'll sell them to whoever's going to buy these next, and the next people are people way down here, and they're like, well, I'll buy them, but I'm buying them here. That's going to cause a gap. Okay. Similarly, a gap up is when there are market buyers who are willing to market buy, but no sellers except at higher levels, right? So gaps occur midstream. And you'll see gaps in crypto, you'll see gaps in Forex, you'll see gaps in all kinds of different assets. Oh man, that green is really bright. Yeah, good point. That profitable timing signals talks about those gaps, right? Now we'll get into, in level 2, you'll get into gap theory and some specific setups that involve gaps, but for our purposes, it's just important you understand that it's literally just a matter of a gap occurs when you've got market sells and no buyers at that level, or market buys and no sellers at that level. Okay. I'm following Sierra Investor on TradingView, but last posted, yeah, Brian almost never posts on TradingView. He will post on Twitter, and he does work on TradingView, but he doesn't do a lot of like publishing or posting on TradingView. When should we look for growth or value companies, or just a matter of personal fit? It's a matter of personal fit. Personally, I've never gotten into the idea of limiting my choices between growth or value companies. I've always been fine with either. And I just look for where the setups are. Grimm, you mentioned that we can share our trading plan with you for critique. How would you like to receive it? Well, what I mentioned before was that when you get to the final exam, there are some long form questions in there where I ask you to describe your strategic and tactical plan, and you can literally just copy and paste your trading plan into those sections. If there's a limit on like how many characters you can put in, I don't know that I've ever seen that limit. People posted some pretty big plans in there. And that way, as part of that final exam review process, I try to provide useful feedback for the future, and so that's a good forum for me to give you feedback on your plan. All right. Grimm, in your tactical plan, you mentioned concentration risk. Do not enter multiple positions in the same account in correlated assets, i.e. ES and NQ simultaneously. Can you elaborate more about this rule? What's ES and NQ? Does that mean, for example, you won't take positions in 2 FANG high-tech stocks simultaneously? So we'll talk more about this in depth next week. Next week we're going over risk management. ES is the futures contract on the S&P 500. NQ is the futures contract on the NASDAQ 100. So most of those are the same exact underlying stocks. So they're highly correlated. The NQ does move more than the ES, and they are weighted a little differently, but they are closely correlated enough that it is a lot of risk for me to be entering trades in both of those. So if the market goes against me on one of them, it is likely to go against me on the other as well. As far as the 2 FANG high-tech stocks, yeah, generally I try to limit that. I've got a little different methodology that I use for my concentration risk when it comes to my swing trading. I use a technique called a profile beta weighting, where I'm essentially trying to keep my overall portfolio neutral with respect to the S&P 500. So for every long position I have relative to the S&P 500, I try to take a short position relative to that so that they cancel each other out. The end result being that my portfolio at large has a very diminished impact by the movement of the broader market. It's a little complicated. I'll talk some more about it next week. But when it comes to my day trading, my prop trading, I'm only holding these positions during the day, so my concentration risk is more about immediate moves. And so the best way to control that is by not entering multiple positions in correlated assets at all. Blocks. I had to step away. Is there a typical time frame we should look at for swing and position trades? I mean, I can tell you the time frames I use for those, but it can be there's a range of them, right? So for day trading, I'm looking at time frames of an hour or less on my charting. For swing trading, I'm looking at things that are an hour or more. I default to a 4-hour chart for my swing trading, but I know plenty of people who do an hour. Um, Most trades I have found take about 30 to 60 candles of whatever time frame you're looking at to resolve. So if you're looking at a hourly chart, and at the minimum you're looking at like 30 hours for that to resolve. So obviously that's no longer day trading, that's going to be swing trading. When we get into position trading, that's where I'm typically looking at like a day, a 1 day chart, maybe a weekly chart, right? But typically a daily chart. And again, it's going to take a month to 2 months to resolve on in most cases. Well, actually, that's not true. It's a little longer when it comes to my position trading, just because of the type of setups I'm taking. Most of my planting flower setups, I think the average length of time for those to complete is 9 months. So those can be pretty long. Um, all right. As part of my trading plan, I set my quarterly goal to do 100 paper trades. At the moment, I'm at 18. Most are on the 4-hour or daily. Is that goal too lofty? It's about 2 paper trades per day until the end of March. Last week you mentioned at this point we should be focusing more on getting the habit of recording our trades than trying to be perfect and following setups. Yep. I guess I'm trying to split the difference by using setups like the bot, Altanginator, and Davo from the library. Well, that's good. I'm also considering 3 reasons to take my trade, while at the same time I'm sometimes playing fast and loose with the criteria. Which is fine. Just make sure that you annotate your trades so you are very clear about like, okay, this is this setup, this is that setup, this is no setup, right? That way you can evaluate the effectiveness with a given setup over time, right? I know we haven't gotten into setups yet, but I want to use some of the criteria, my paper trades to make sense. That's fine. I'm trying not to force them. To record a higher volume of good paper trades, would you recommend looking at lower time frames on high liquidity assets like BTC? Sorry for the long-winded question. Okay, so few things. Whatever time frame you suspect you're going to be trading when you are done paper trading, whatever time frame you're going to be trading with live money, that's the time frame you should be paper trading. That's what you want to get comfortable with. If you are paper trading on 5-minute charts, but you know you're going to be trading 4-hour charts, how those work psychologically is going to be very different for you. And so you're not really preparing yourself and you're not really becoming comfortable with waiting for 4 weeks for a setup to finish if you're doing like 5-minute charts, right? Just don't rush it, right? For me, swing trading, so trading on 4-hour charts, it takes me about 90 days. It's taken me as much as 180 days, right? Take it 6 months. But typically it takes me about 90 days to get 100 paper trades on a setup. Obviously, a lot of that depends on the setup. Some fire more than others, right? But I would say just remember it's a marathon, not a sprint, right? I don't know about it being too lofty, as I said in here. You might find you hit it a couple weeks after level 1 wraps up, right? And that's fine. Yeah, I think that's about it for that one. Eddie says, I think this is what we're looking for. Low volume results in high volatility and big moves. Those we need to pay attention to and find good trades. I mean, you're not wrong. But it's, I guess, I think this is in regards to the question earlier about whether we're moving the markets with our trades. It's it has to be a pretty illiquid market for you to move the market with $1,000 trade, like kind of scarily illiquid. So, not saying absolutely don't trade it, but illiquid markets have a lot of risk. It's hard to get out of your position and take your profits, right? Where was I? The course PDF talks about the US dollar index as an excellent source of a non-correlating asset. Which asset classes does it not correlate to? Conversely, which classes does it correlate to? There's very little, I can't think of anything off the top of my head that correlates with the US dollar. I think that's kind of the point of it. We want an asset that does not correlate with the other markets. So, how do we figure out when to enter the trade? Then we found our reasons. I think I talked about this earlier. I've got a couple different methods that I enter off of an M or a W. The cheapskate version is to look for the candle body open of the candle that confirmed the structure. The other way to do it is to look for the midpoint of that structure. So like the middle low for an M or the middle high for a W. And I look for a pullback to that level, and that's where I get in. Okay. What does lot size mean? So a lot refers to sizing for Forex pairs. So I provided an article on Investopedia for the details on that. What are reload zones in regards to fib retracement tool? We'll get into that in week 6. You're getting ahead of yourself there. How would one know if they are prepared to trade at a prop firm? By the end of level 1, do students have the proper know-how in order to trade at a prop firm? Well, so the order of operations goes like this. Once you have a setup you understand, the next step is to paper trade it. Once you have paper traded that setup, 100 trades. So that's 5 20 trade sets. If you are winning with that setup at least 66% of the time, and that setup is giving you at least a 2-to-1 risk to reward, then you're in a pretty good position. At that point, you're at a point where you've done your paper trading. You are now at a point where you're willing to put some money on the line. That is the point at which I would take a look at a prop firm. The risk that you have with a prop firm is going to be much less than the risk you're going to have trading with your own account, typically. Now, that's going to depend a little bit on what you're trading. If you're trading crypto, you might get away with trading $20, risking a total of $20 in your profile or your portfolio on crypto, and get your trades in that way. Well, that's going to be lower risk than spending $100 at a prop firm, right? I would go with whatever the lowest risk approach is that you are comfortable with. For many people, they're going to be looking at trading more than $100. And if you're looking at trading more than $100, I would encourage you instead to go to a prop firm and go through the evaluation at that prop firm. If you can pass that evaluation and make money at that prop firm, after you've made money for a few months at that prop firm, and I would say a minimum of 4 months, closer to 6 months, then and only then are you ready to start trading with your real full-size portfolio of your own money. Now, all of this is predicated on what you want to trade. If what you want to trade is crypto, you can do that at prop firms. You pretty much need to do Forex prop firms. So you're talking about FTMO or My Forex Funds, something like that. Osprey FX, I think, has a prop firm thing they're doing now. All of those will let you trade Bitcoin, Ethereum, Litecoin, and generally maybe a couple other crypto assets. And that's pretty much it. But it lets you trade those crypto assets in a way that you are limiting your overall risk. And that's the name of the game. It's after you've done your paper trading and you're winning at the rate that you're looking for, right? You've got that 66% win rate. You've got 2-to-1 average, 2-to-1 risk to reward or reward to risk. At that point, the safest way to go is either a very small account on crypto or a small prop firm account, right? You want to minimize how much you're risking while you're learning, knowing that the likelihood is most traders, because you're just exposing yourself to the really heavy behavioral risk stuff, you're probably going to blow up that account. You might blow up a few accounts. If you keep those accounts very small, that's not that big a deal. Blowing up a $20 account as a learning lesson is painful, but it's not going to break you, right? Blowing up a $100 account at a prop firm. Does it suck? Yeah. Is that going to impact your ability to pay your bills? Probably not. So that's really what it comes down to. You want to minimize your risk while getting as much exposure to the markets as you can. Okay? So that's what that's about. Remember, if you go to set up an account at a prop firm and you blow up the account, there's no stigma associated with that. You just set up the account again or reset the account. Continue on. You know, they see it all the time, and that's how a lot of traders learn. A lot of traders learn. They get their chops trading by setting up prop firm accounts, evaluations, and just working on it. Okay, they blew it up. Now they got to adjust their plan. They adjust their plan. Okay, they blew it up again. Okay, they adjust their plan. There's cost associated with that, but it's you're minimizing the cost associated with that versus trading with your live money. Okay. Now, hopefully, you're going to follow what we've taught you, and you're not going to blow up accounts repeatedly. But it can happen, and I think you need to be realistic about the risks with that. Okay. A couple questions related to question 15. Paper trades. Would it be better to paper trade with a lower time frame trades, get used to the high stress anxiety so we can trade at higher time frames with less anxiety? Ironically enough, the anxiety can be higher on a larger time frame because you're waiting for a lot longer for something to happen. So a lot of it depends on your mental state and what impacts you, but I personally have seen, and well, personally is maybe the wrong word, but I have seen with students a fair amount where they did their paper trading on a low time frame, 5 minute, 1 minute even, and then they moved in to do swing trading, and they could not handle they couldn't handle sitting on a trade for 80 days. Right? There's a lot of stress associated with that. There's a lot of difference in how you trade. You know, you want to be really, really slow and careful about getting into a trade that you're going to be in for 80 days versus one that you're going to be in for 30 minutes. So, Block says, I was trying to figure out the appropriate time frames. Grimm used 30 minutes and then 5 and 3 for his day trading. Whatever swing trading was just covered. Yeah, I talked a bit about that. Blocks. For my swing trading, I use a 4-hour chart. My higher time frame I use for that is weekly and then daily, and then I use a 4-hour for my setups. That's for my swing trading. Talking about supply issues, what are credit squeezes? It's already 11 o'clock. Let me get into credit squeezes. I mean, you can ask Brian about it in the Broiler Ticket Show, but if not there, ask this again next week. And I will, that's not what I wanted. That and that. Ask this again next week, and I will spend some time talking about it then. Is the slide in an asset structure meant to just give an overview of the most important facts we should remember about the assets when trying to gauge their value? I understand the details of the slide, but not what structure means in this context. All right, well, first of all, yeah, it's just meant to give you an overview of the important facts you should remember about the components of an asset, like how that asset is structured, how it works. I'm not sure if that answers your question or not, but yeah, that's just meant to give you an overview of the assets. I don't fully understand the concept of share consolidation. Okay, so the easiest example of share consolidation is this. So, company has their shares out on the New York Stock Exchange, and for a combination of reasons, the price has been going down and down and down and down and down, and now they have breached $1, and their shares are worth 90 cents a piece. The New York Stock Exchange gives them a window of time. It's short. It's like 2 weeks or a month, maybe it is, to get their share price above $1, or they will be delisted from the New York Stock Exchange. Meaning people can still buy and sell shares, but it's all done through OTC markets, and it's certainly not going to happen with a majority of investors. One of the tools they have at their discretion is to do a share consolidation. If their shares are worth 90 cents and they do a 2-to-1 share consolidation, so every 2 shares is now worth 1 share, is now the equivalent of 1 share, then each of those shares is going to be worth $1.80, which keeps it above the $1 threshold to keep it listed on the New York Stock Exchange. The problem is when that occurs, that tends to accelerate the selling pressure on the asset itself because people see that as a desperation move. Share consolidation is often seen as a desperation move, and this results in the price then driving down. So they did the consolidation, which set it at 180, and now there's a bunch of extra selling pressure on it, driving the price oftentimes then back below $1. So, so that's basically what we're talking about there. What is an option strike price? Well, we don't get too much into options, but it is important to understand this for next week because we're going to talk about buying put option insurance for our portfolio. The strike price of an option. So an option is a contract that says if I'm buying the option contract, I am buying the option to buy that asset, usually in 100 share increments, at a given price by a given date. Sometimes on that given date, but for American style options, it's by that given date. What that means is that the strike price, that is the price at which I am saying I can buy that underlying. How do I put it? If I am buying a S&P 500 contract, options contract, and I'm like, okay, I'm going to buy a put option. So the put option allows me the option, but not the obligation to sell 100 shares of this at a given price by a given date. Okay. So if I'm buying a put contract, I'm saying I want this contract that I've bought that says that I can sell these S&P 500 shares at $4,450, let's say. It's way up here. Okay. anytime before X date. That date can be 6 months in the future, whatever. That $4,450, that's the strike price. Now, for somebody to sell me this in the money option put, they're going to charge me a premium, and the premium is generally going to be the difference between this and the current price plus some volatility. Okay, that's the premium that I pay for the right to sell that. Okay, but that strike price, that's the price at which I am contractually able to sell that asset at in the case of a put, or buy that asset at in the case of a call. All right. Fundamental analysis tools. CAN-SLIM. What is meant by L? Relative leadership. Top 5% relative performance. We're talking about leadership within the industry. So there are different measures of industry leadership. There's a measure called performance, and what we want to see is that you're in the top 5% of that industry for performance. If you are Microsoft, you are in the top 5% of performance for software manufacturers. Okay. What's the difference between a prop firm and a family office? Oh, those are utterly different things. A prop firm, a proprietary trading firm, is a firm where they're providing capital to traders, typically after they prove themselves with some kind of evaluation process. A family office is a business structure for the organization of typically pretty high net worth small businesses and trusts. So very different things. Almost unrelated. Related only in the sense that they're both types of businesses. So I think Investopedia has an article on family offices. There you go. Family offices are private wealth management advisory firms that serve ultra high net worth individuals. Yep. There we go. Very, very different thing from a prop firm. Isn't it better if you do this group tutorial on Hangout so there's no delay between you and us? No, not generally. You want to see me get derailed a lot. If I do this as a Hangout, it's going to be it's going to be a lot. Also, and the main reason that I do a YouTube broadcast instead of a Hangout is I can't broadcast a Hangout in 1080p. I'm limited to like 720p. And I have had complaints in the past about image quality when they're wanting to see charts and things like that. And also a YouTube link for those who don't want to go there and watch it later, just like Brian does the daily brief. Yep. Also, tertiarily, we have over 100 students in here. And so Hangout doesn't work as well for something like that. So when you're in the midst of a trade and you're waiting, say, 10 hours, like you mentioned earlier, is it advisable against taking another position on the same asset? Yeah. Yeah, I think it's a bad idea to do multiple positions on the same asset at the same time. Not to say I won't ever do it, but you need to be cautious about it. I mean, it's that whole concentration risk thing, right? So we're going to study trading seasonality in this level or any level. We cover seasonality in level 3. I definitely use seasonality. And Brian will talk about the move of capital between different industries and sectors. But it really is a level 3 concept. It gets a little complicated. Hey, Graham, talking about ranges. Can you draw the weekly, daily, 4-hour horizontal support and resistance and explain how to do it? We have a look. So we cover horizontal support and resistances in level 2. There's a thing we do in there called a Grimm matrix, which would probably be pretty interesting for you. That's related to that. Do you have a list of books you recommend? Maybe some you consider a must-read or somewhere you found really valuable. I think the single most important book outside of our course material that any student in level 1 can, should, and is like on my absolute must-read list is Trading in the Zone. It is there are a handful of books that deal with trading behavior, and that one is one of the best. And I highly, 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 highly recommend it for level 1 students. I think that's very important, and I think it's very valuable. I don't know if it's too early in the course, but I don't get the idea on where to enter in a trade. I mean, steps to follow. First, price structure, then divergence. So there is a specific order of operations. So the first thing I look at, which you haven't learned yet, is location. So you'll learn that in, I think, week 7. Week 6, fib levels. So not this next week, but the week after, you're going to learn about location. And that is always the first thing I look at after fundamental screening. When I'm looking through the assets, I look at location. So you're going to look at location, then you're going to look at momentum, and that's where you're looking for divergences or convergences in the case of a trend following setup. Then you look for price structure. So once you have the price structure in place, that's going to tell you where you're going to enter the trade. Now, again, you don't look for price structure until you already have momentum and you already have location. And this will come together as we go through the course too. I'm going to talk about this a few times, so don't feel like you have to get this now or forever hold your peace. We're going to get into the details of this repeatedly. Okay. So you've already got your location. You're in a good location. You already got momentum divergence, let's say. You've got price structure. That price structure tells you here's where you enter the trade. Here's where you set your stop. There are some location tools we're going to learn in a couple weeks that are also going to tell you here's where you take profit on that trade. And that's how you go about it. It's a very checklist based. Okay. So you can literally have a checklist in front of you like, okay, do I have location? Yes. Well, actually, starts off before that. Is this FA screened? Yes. Okay. Which FA screener did it pass? Okay, there you go. Is this in a good location? Check. Do I have momentum signals? Check. Do I have price structure? Check. And then you're good to trade. Okay. What do I think about mastering the trade? Mastering the trade is good too. I don't think I've read through the tech analysis of the financial markets by Murphy yet. I don't think there's any books necessarily that aren't for level 1ers. I just think there's some elements that are particularly important that folks in level 1 get when it comes to trading. And I think one of the biggest things is that behavioral psychology part that's covered in Trading in the Zone. Really understanding that what we're looking at is not individual trades, but batches of trades, and really thinking in probabilistic terms is huge. So that's really, if I was going to say you must read a book, that's the book that I would say is kind of your must read. All right. I think that is all the questions in the Q&A sheet. Did I miss anything in chat, guys? If you asked a question I didn't get to it, can you post it again or point it out so I can make sure we get everything answered? All right, I don't see any other chatting in here, so I think we've probably covered everything. Guys, I'm going to let you go. It's about 11 o'clock, so we're about 3 hours in. Didn't quite make that 2 hour window, but that's okay. A lot of really good questions in here. Hopefully I answered them all for you. If I did answer your question, but I didn't fully answer it, and you still have more question about it, just let me know. You can post it in next week's questions. We'll get through it eventually. I don't ever mind hashing over the same material multiple times because for many people they just need to hear it in a little different way, and that's fine. Okay. Well, that's interesting. Skyfire is saying that Larry Williams' son wrote a book called The Mental Edge in Trading, talks about statistical correlation of big five personality traits from top traders. Yeah, that's interesting. You might also take a look at what's that called? There's a firm that Ray Dalio helped put together called Bridgewater Associates. And they have a separate personality test that they do for all their employees, but it's publicly available. There it is, Principles U, where they assess like what are your core principles and how that fits in. I think it's particularly interesting because it's built by an investment fund for the use for their traders, so, and their employees. So kind of directly relevant. So kind of interesting stuff. Awesome. Thank you, Skyfire. That's great. All right, guys. I'm going to let you go. Brian, I don't know if you're still watching, but you can take it away in the Broiler Chicken Show if you haven't started it already. And bye for now.